Why use loans? Why borrow your own money out of an IUL policy, Index Universal Life? How do loans work? And that extra 2% allows you to increase your payout from 8% to 10% without depleting principal. It's incredible once you understand this is the smart way to access money. This is probably the most misunderstood concept in accessing your money the smart way out of an insurance contract instead of the dumb way or the sad way. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of people optimize assets, minimize taxes, and empower their authentic wealth. My favorite vehicle, without question, to accumulate money tax-free, then be able to access that money tax-free income at a 10% payout. What do I mean by that? Every $1 million that you accumulate inside of an IUL can generate $100,000 a year of tax-free income from age 65 to age 120 without depleting principal, okay? We have done this for years. And so you can accumulate the money tax-free, and it knocks the socks off of traditional IRAs or 401ks invested in a volatile stock market. But also at the end of the day, when you die, whatever's left in the policy, the cash value, blossoms and it transfers income tax-free. It usually pays out more than the cash value because there's a death benefit there, okay? Nothing else does what I just described in the Internal Revenue Code. I've taught years advanced continuing education to CPAs and tax attorneys. I've yet to have anybody show me any other financial instrument that does that. So when people say, Doug, how can you access money out of an indexed universal life policy? And I usually say, well, there's the sad way, the dumb way, and the smart way. Well, what's the sad way? It's by dying. It's one heck of a return, but I don't recommend that one. But see, if I take out an IUL policy, even if I'm taking the least amount of insurance that I can get away with in the Internal Revenue Code under TEFRA and DEFRA tax citations that are explained on many videos on this channel, I might set up a policy for a 60-year-old to accommodate $500,000 of premiums so that $500,000 will grow and double to $1 million, $2 million, $4 million, $8 million, which we've done for many clients, and it's tax-free. The least amount of insurance for a 60-year-old to be able to put in $500,000 is only $1 million. Well, that's because my goal and objective is tax-free accumulation. So then they say, well, when it comes time to access money, you're saying, Doug, that every $1 million I've accumulated can generate, $80,000, $90,000, $100,000 a year of tax-free income. How do you do that? Well, I would recommend you don't do it the dumb way, okay? Well, what's the dumb way? Withdrawing your money. See, this is foreign to a lot of people in their normal thinking because you think if you have money in a mutual fund or an IRA or 401k or a bank or credit union, you begin to withdraw your money. Well, if you did that with IUL and you put in $500,000 and it's grown to $1 million and that $1 million doubled to $2 million and maybe it doubled to $4 million, doubled to $8 million, which we've had clients do that. At whatever point in time it grew, the beauty of life insurance is when you start accessing your money, withdrawing it, you can withdraw up to your basis, the amount you paid into it, and there's no tax. You're recovering your basis. And that's called FIFO tax treatment. The first money you put in is the first money out, where a lot of investments are taxed LIFO. So it's an advantage right off the bat because it's one of the few investments in the Internal Revenue Code that gets FIFO tax treatment. But after you've recovered your basis, now you have to pay tax. You're triggering unnecessary tax. That's dumb. Dumb. The IRS actually says you don't have to do that. You can get away with not paying tax if you change the nomenclature to a loan. Okay, just simply call it a loan. And the next question people ask is, well, why would you borrow your own money? You're not. So listen very, very close. Let's use $1 million of cash value as an example. That $1 million of cash value, you could go borrow, $940,000 of it in one fell swoop, and the policy wouldn't lapse. Okay. After a few years, if you never started paying interest on it or whatever, or paying premiums back into it, it could get in danger of lapsing. But most people, they don't do that. They could, but they start just taking out the equivalent of their interest. So if that $1 million is generating 10%, or even an index universal life, it only has to generate 8%, but you can pull out 10% without depleting principal. And people go, huh? How can you pull out 10% when it's only earning 8% and not deplete principal? So you need to watch several episodes based on IUL terminology here, but I'm going to give you a sneak preview. Okay, now, if I use the cash value, the $1 million as collateral, okay, if you had $1 million in a certificate of deposit at a bank, you could go withdraw that from the bank. Now, it would no longer be in the bank earning interest, but if you went to the bank and said, I don't want to withdraw the $1 million, I'll leave it there, and that's collateral, would you loan me $1 million? Absolutely. They'll loan you $1 million if they have that as collateral. If that $1 million that you have in the bank in a savings certificate is collateralizing the loan, why wouldn't they loan you $1 million? Okay. Now the problem is with the bank, they're probably only crediting you, 1, 2, or 3%, and they'd be charging you 6, 7, or 8. That doesn't make sense. With an insurance policy, it's the opposite. Okay. There's two ways to access money, simply put, in the form of a loan. There is a zero wash, or what is sometimes called a zero cost loan. So if you feel like the economy is going down, that is the choice you would use, and you can change which loan provision annually, okay? And so if the economy is going down, you may say, okay, I want to borrow $100,000 a year, or maybe borrow $900,000 out of my $1 million of cash value. But if you borrow it, they're going to say, do you want to do a zero wash loan or a low cost loan? Yes, if you feel like the economy is going down, because they might charge you 2%. 2% on $1 million. Let's say you go borrow $1 million. That's 20 grand. Oh, why would I pay 20,000 in interest, 2%? Well, that's a pretty good interest rate, number one. But number two, it's because the $1 million of cash value that's collateralizing the loan from the insurance company is going to be credited the same 2%. So you leave $1 million in there being credited 2%. At the end of the year, that is now worth $1,020,000. And over here, you have $1 million plus 20,000 of interest. So you have $1,020,000 loan, you have $1,020,000 of cash value now. This equals that. It's a wash. Didn't cost you anything. But it made the money tax-free. When is the loan due and payable? Technically not during your lifetime. It's washed away when you die, because the death benefit minus the loan balances and accrued interest will always leave a net death benefit because of the way you structure it, so you don't over loan or over borrow, okay? And so this is incredible when you understand how this works. And there's another episode I'm doing on how to have an overloan protection rider and so forth, so that it's impossible, more or less, to be allowed to borrow more, so that the policy would crash and burn, because that might trigger a taxable event on the money that was changed from loans now to a withdrawal, and you have to pay tax on the gain. You don't want that to happen. So we've never had that happen unless the client didn't know what they were doing and they were convinced by some other agent to cancel their policy, and it's because other agents didn't know what they were doing. There's a few sob stories about that, but never intentionally do we ever allow a client to make that mistake. Now, let's get back to the reason why you would borrow your own money. It's tax-free, number one. Number two, if you're feeling bullish about America and you think the economy is going to continue to grow, even though there's going to be ups and downs in the meantime, then you can use an indexed alternative a participating loan. We'll just call it an alternative loan, because companies that offer index universal life will allow that kind of a loan too. And that's where they charge you a little bit higher interest rate, let's say 4% or 5%. And why would you pay 5% interest? Now you borrow $1 million and they're going to charge you 50 grand in interest that year. Again, you don't have to write out a check for that. It's just accruing. So here's 50,000 of interest on this phantom loan. Okay. So now you owe them $1,050,000. Over on this side, the $1 million that's collateralizing the loan is going to be credited with the index rate, not a fixed rate. Now, yes, there will be some years that's zero, And zero is your hero, remember, because you don't lose if the market goes down. But if they're charging you 5 and you got credited 0, you may be down a little bit that year. But if generally speaking, you understand Index Universal Life, that 7 out of 10 years, based on actual historical performance, you are going to be making money, and it's going to be far more than 4 or 5%. It's going to be averaging more in that 7 to 9 to 11% range if you're rebalancing and diversifying. So with many of our clients, they have, by rebalancing and diversifying with annual reviews, they get credited an average of 11, a little over 11. And because we've squeezed down the death benefit under TEFRA and DEFRA, the net rate of return is 10%. They're earning 11, they're netting 10 because we structured it properly, which is another video in this series here. Well, that means if they're earning 10, they're charging you 5, they're crediting you 10. How much more is 10 than 5? Don't say 5. It's 100% more. Okay. Would you hire an employee for $50,000 that made you an extra $100,000? Okay. Are you getting it? They're charging $50,000 of interest, but over here they credited $100,000. Okay. So now you have $100,000. Now this side of the ledger is at the end of the year worth $1,100,000. The loan balance is $1,050,000. $1,100,000 minus $1,050,000, you made $50,000. You netted 5% tax free on your million while you were using it for something else in your business. Is this making some sense? So this is incredible, and I want you to watch the episode that talks about this, because I've had many, many clients who have borrowed with an index loan at 5%, and that year they got credited 25%, 5 times what the insurance company was charging. Even in 2020 to 2021, you borrow at 5% and they got credited to 61.33% when they linked to a 1-year point-to-point with no cap because of COVID-19, okay? Those opportunities are far and few between, but let me just say, this indexed alternative loan is what allows IUL policyholder, if they're only averaging 8%, to be able to withdraw quite easily 10%. $1 million can generate $100,000 a year of tax-free income, even if you're only earning 8%, because that extra 2%, that spread is being covered because you're borrowing $100,000 instead of withdrawing money. You're borrowing $100,000, and they're charging even 5%, but they're crediting you 2% or more, and that extra 2% allows you to increase your payout from 8% to 10% without depleting principal. It's incredible once you understand this is the smart way to access money. You're actually borrowing money from the insurance company. The insurance company is loaning you money based upon your cash value that is collateralizing the loan. They're just asking, do you want us to charge you 2 and credit you 2 so it's a 0 net cost? Or do you want to be charged 4 or 5 and we'll credit you whatever your index does? Yeah, some years may be less than what they're charging you, but most years it's going to be much greater. And that's usually going to average maybe double what they're charging you. And this is magic. This is how money works. This is how banks, credit unions, and insurance companies make money. They borrow money, OPM, and they pay a lower interest rate than what they're earning. You can do this. This is how to become your own banker. So hopefully you are getting a glimpse of why you would use loans. I'm going to also simply suggest that all the money you take out in the form of a loan, you don't have to pay back. But it doesn't mean you can't. What I mean by this is, let's say you were 65 years old and you started taking $100,000 a year out of $1 million of cash value, and it's a net payout of 10% because that's what you're earning. After 20 years, you pulled out $2 million in loans, plus accrued interest. Let's say you got an inheritance or a windfall of a few $1 million or $2.5 million or something, and you're going, oh, golly, where can I put this money? Where can I invest this money? I'm not healthy enough to qualify for these anymore. I said, oh, no. You simply reinvest it in your IUL policy. Well, that violates TAMRA. No, you've already satisfied TAMRA. You're paying back a loan. You have $2.5 million of loans that you don't have to pay back. They're not due and payable during your lifetime. It doesn't mean you can't. The insurance company says this is new money coming in. The IRS says, oh, they're just paying back loans. You put in $2.5 million in one fell swoop, and now you're back to where you started, and that money hits the ground running. You don't have to go through 5 years of TAMRA, and you could start pulling out $250,000 a year instantly from the $2.5 million you were allowed to put into that policy because you paid back a loan that you weren't required to pay back. It's like reinvesting money under an old grandfathered tax law. Does that make sense? If this is blowing you away, I hope so. You can learn more by studying my most recent best-selling book, The Laser Fund. It's 300 pages, jam-packed with information. 2/3 of it is the left brain charts and graphs. The other third, you flip it over, and that's 62 actual stories. And so whether you're right brain or left brain, I would recommend you study this book. On Amazon, it retails for $20 plus shipping. If you buy one on Amazon, thank you, but I'll gift one to you free. Simply click on the link below to go to laserfund.com. You contribute a nominal amount towards the shipping. I require a little bit of skin in the game. I'll cover the rest of that cost, but I'll pay for the book, and I'll fire out a hard copy to you via priority mail. When you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out those options. But here's the deal. If you want to make absolutely sure, and you're a member of the general public, and you want to make sure your IUL is structured right and you do this right, okay, because so many agents don't understand this, you could ask most agents this question. If they hum and haw and don't know the answer, that's pretty close to what I just gave you, that's a red flag. I would recommend that while you're in there claiming your free copy, that you can schedule an appointment with a member of our IUL insiders that have been certified. Now, we have over 1,000 members of IUL insiders, but a very, very small percent have become certified because it's a 100-question exam and you have to get 100% to be certified. I would recommend, if you're wanting to make absolutely sure an IUL policy is structured right for you, that you work with a certified IUL professional, and you can set up an appointment with no cost or obligation when you're in there claiming your free book. If you're an IUL professional and you're going, oh my heavens, I need to learn this kind of stuff. My client read this book and knows more than I do. Well, I'd recommend that you start learning. So go to IULinsiders.com, and I'd recommend that you become a member of this coalition and network, and that you work very, very hard to become a certified IUL professional if you want to help your clients the best way.